since 2018, we've had an issue with the underperformance of actively managed diversified equity funds. So what does 2021 have in store? Can the market rally lift all boats, or will the resurgence of COVID cases dampen portfolios? Feroze Azeez, Deputy CEO of Anand Rathi Wealth Management, joins in now with his alpha update to tell us about what's the status so far and what lies ahead. Feroze, good afternoon. Thanks very much for joining in. So this alpha has been so elusive. What has been the experience of the last 3-4 years, and how does it compare with 2021? What does it tell you about how this year is going to shape up?
Sumaira, when it comes to alpha of these active fund managers who are there in the marketplace wanting to manage retail money and HNI money, if you look at the last decade, 62% of the funds which are available in the open-ended category have generated an alpha over Nifty in the corresponding year. So that's point number one. Number two, 2018-19 have been very bad years when it comes to alpha over Nifty. Only 2% of the funds available in 2018 have beaten Nifty. 2019, 22%, but the average has been 62%. So one great part of piece of data, which is the large debate which happens between active and passive managed funds, 62% have beaten Nifty. Then comes to 2021, which is the calendar year we're speaking of. We are already a quarter into the year. 80% of the open-ended funds, which is 236 funds, 80% of them, which is 189 funds, have beaten Nifty for this 3-month period. That's the piece of information when you compare these open-ended funds, 236 of them, with Nifty. Now, if you do a deeper analysis with respect to their benchmarks, which each of them have chosen, 50% of them have beaten their corresponding benchmarks for this calendar year so far. And last year, about 38% have beaten their own respective benchmarks. So point one to infer is that active management can generate alpha, and 2018 and 19 were exceptions. To answer your pointed question, 2021 has a great alpha story in store.
Yeah, so, what is it that has changed? I mean, is it the market? Is it the schemes? What is it that is helping the outperformance?
See, Sumaira, the alpha comes in a mutual fund if the broader market, which is not just the top 5-10 stocks of the market, perform. So if you look at 2018 and 19 and try and derive some inference from this data, in 2018, the top 5 stocks of Nifty delivered 7%, whereas the overall Nifty delivered only a 3% return, which implies the top 5 did better than the rest of them, which is the 45, twice as much. So more the concentration in the rally, lesser the chance that a mutual fund, which is a diversified platform, will outperform. So in 2020, second half especially, mid caps and small caps and the broader market started doing relatively better than the Nifty. That's when these mutual funds, which average have 45 to 50 stocks, tend to outperform the corresponding benchmark. So this is one big strong reason. Second strong reason is it is not just a sector-specific rally. Now, over the last 7-8 months, you've seen turn by turn, each sector has done its bit to contribute on Nifty. Broader stock-based rallies and non-sector specific, broader sector rallies have helped alphas to come back. And I think that's a very positive sign. And these alphas are post-cost differential compared with Nifty.
Okay. So basically, a lot of people might have actually redeemed their funds. If they were to restart their SIPs or, make fresh investments, would they still be beneficiaries?
Yes, Sumaira, what comes out very clearly from this data of the last decade is that there's no trending downwards. What has been worrying people who are mutual fund investors is the alpha probability and the potential of fund management, active management, is reducing gradually. But this very clearly says that there have been years where there's been no alpha. Subsequently, alpha has come back. That means there's no trending downwards. in terms of the propensity for alpha generation. So to answer your pointed question, if somebody was out of the mutual fund industry, if he or she came back expecting a 2% alpha over the corresponding benchmark of the chosen fund, is not a low probability event, and outperforming Nifty by 2.5–3% every year over the next decade, if you are capable of choosing the right 8–10 funds out of the available 236, is a very, very good news, because this 2–3% alpha after cost can add up to a large corpus equal to the corpus you begin with in 10 years.